All right, so we're diving into these reports from Gilt Investments today, all about fixed income. And, well, it seems like there's a lot going on in that world,
Yeah, there's a lot to
to
unpack.
say the least, right? I mean, we've got these trade wars heating up, central banks trying to figure out what to do,
Hmm.
and then the Aussie dollar
Yeah,
is
the Aussie dollar's not looking so good.
not looking so hot, no.
Hmm.
So we're going to try and make sense of it all today, figure out what it means for all of us, for our own investments. So I guess first, let's talk about these trade wars everybody's so worried about. I mean, President Trump, he slapped those tariffs on Canada, Mexico,
Right.
and China. Big tariffs, like 25% on some things.
Huge, 25%. That's going to cause some problems.
Yeah, and then naturally they retaliated. They hit back with their own tariffs. So what's happening? What's the fallout from all that?
Well, yeah, no surprise the markets are kind of freaking out a little bit.
Mhm.
Wall Street's on edge. The U.S. dollar is surging, which is not great for emerging markets. And
Mhm.
then closer to home, I mean, the Aussie dollar, it's really taken a hit against the U.S. dollar. I mean, it's sitting around 0.61 right now.
0.61, wow. So what does that actually mean for, someone like me, for the average person, besides maybe having to cancel that overseas trip?
Yeah, besides that European vacation, well, it means that, I mean, pretty much anything that we import is going to get more expensive. That cup of coffee we were talking about before.
Yeah.
Yeah, that could cost you more. And all of that, that can push inflation up here in Australia. And when that happens, well, your money just doesn't go as far anymore.
Yeah, not what you want to hear, that's for sure. So with all this going on, what are central banks doing? Are they worried?
Oh, they're definitely watching, definitely paying attention. The U.S. Federal Reserve, they've decided to hold off on cutting interest rates for now. And we're seeing other countries like Chile, Sri Lanka, even Hungary, they're doing the same thing. Everybody's really keeping a close eye on inflation.
It sounds like they're all trying to walk this tightrope between trying to keep inflation under control and also not wanting to, cause even more panic in the markets.
Yeah, absolutely. It's a delicate balancing act for sure.
For sure. Speaking of things that might make people panic, what's going on in Japan?
Well, Japan's a little concerned about how volatile the yen is right now,
Mm-hmm.
with all these trade tensions.
Mm-hmm.
Their economy depends a lot on exports, so if the yen's fluctuating all over the place,
Right.
that causes a lot of uncertainty for them.
Makes sense. So bringing it back to Australia, how are our bond yields looking?
Actually, Australian bond yields have been climbing, which is interesting. The 10-year bond yield hit 4.41%.
4.41%. Okay. So for those of us who don't, speak finance, what does that actually tell us?
Good question. So basically, it suggests that there's a lot of uncertainty around what the Reserve Bank of Australia, the RBA, what they're going to do next. Remember, bond yields, they go up when bond prices go down. Some investors might be selling off those bonds.
Right.
That'd be because they think interest rates might go up in the future.
So it's all kind of connected then.
Yeah.
These global trade wars, the impact on the Aussie dollar, inflation, and then everyone's kind of looking at the RBA. It's like, okay, what are you guys going to do?
Exactly. It's like this big chain reaction.
Big chain reaction. And then to add to all that, our treasurer, Jim Chalmers, he's been saying that, things are a bit rocky here in Australia economically, right?
He's admitted that the landscape's not looking as smooth as we'd like right now.
So where does that leave us in terms of interest rates? I mean, is the RBA going to cut them, try and, stimulate things?
Well, inflation did actually drop to 2.4% in the last quarter of 2024, partly because of the government's energy subsidies.
Mm-hmm.
But the RBA is being really cautious. They're even telling, superannuation funds to hold on to a good chunk of cash,
Well,
just in case things go south. It's
yeah.
like they're saying, hey, be prepared.
Yeah, that's definitely a signal. Okay, so we've got these trade wars happening, central banks walking on eggshells, and the Aussie economy, doing a bit of a wobble.
Yeah.
It sounds like Gilt Investments, they have some advice on how to deal with all this chaos, right?
They do, yeah. They've put together this kind of playbook for fixed income investors with some specific strategies for navigating this, volatile market.
A playbook, okay. All right, I'm ready. Hit me with the first play.
All right, so play number one. Don't put all your eggs in one basket. Gilt really stresses diversification.
Mm-hmm.
So spread your investments across different types of assets like government bonds, corporate credit, even inflation-linked securities.
So a little bit of everything just to kind of balance things out.
Exactly.
Yeah.
Especially when things feel this unpredictable.
Right. Okay, what else does Gilt recommend?
Well, they're really big on prioritizing quality. especially right now. So they say think about investment-grade bonds, particularly the ones issued by blue-chip companies, especially the ones based here in Australia.
Okay, so the big, reliable companies.
The ones that are less likely to just disappear overnight.
Yeah, those are the safest bet in this kind of storm. All right, got it. What's next in the playbook?
Okay, so next up, they emphasize liquidity, having easy access to your money. So they're kind of echoing the RBA's warning there, suggesting that investors should keep some of their portfolio in things that are easy to get to, like short-term bonds or money market instruments.
Okay.
Those are the kinds of things that mature really quickly, usually within a year.
Mm.
So if you need to get to your cash quickly, you can...
Like an emergency fund, but for your investments, right?
Exactly, exactly. Good way to think about it.
Makes sense. Okay, what about inflation? I mean, how do we protect ourselves from that, especially if the Aussie dollar keeps, dropping?
Well, Gilt's advice is to think about adding inflation-linked bonds, things like Treasury index bonds to your portfolio.
Mm-hmm.
Those can help to kind of offset those rising prices.
So these bonds, they're kind of like a shield against inflation, help you keep up even if prices are going up.
Exactly. That's a great way to put it. They adjust with inflation, so your purchasing power stays more stable.
Okay, that's good to know. All right, and last but not least, what's the final play?
The final play is a simple one, but so important. Stay informed. Things can change so quickly, so you really need to keep an eye on the news, especially anything about central banks and government policies.
Right, because one little policy change could, send everything into a tailspin.
Absolutely. Stay vigilant. Keep your ear to the ground.
Got it. Okay, so we've got Gilt's Big Five. Diversify, prioritize quality, stay liquid, consider inflation protection, and stay informed. That's a lot, but I think it's a good starting point, right?
It is, yeah. It
Yeah.
gives you a solid framework to work with.
So let's break it down a little bit. Let's say you're an investor who, doesn't want to take huge risks, but you want to build a portfolio that can handle, all this craziness that's going on. Where do you even start?
Well, following Gilt's advice, I'd say the first step is to put some of your money into Australian government bonds, especially the ones with shorter maturities.
Okay.
Those are considered some of the safest investments you can make.
Okay, so that's like our base, our solid foundation.
Yeah, exactly.
So what kind of returns are we talking about with those right now?
Well, like we said, the 10-year Australian government bond yield is sitting at 4.41% right now, so that gives you a general idea.
Okay.
But remember, bond yields and prices, they move in opposite directions. So if interest rates go up, those bond prices tend to go down.
Right. So there's no guarantees, and we got to keep an eye on those interest rates. Okay, what's next on the list for a good balanced portfolio?
Okay, so next, we'd add in some corporate bonds, but focus on the ones issued by companies with good credit ratings, those investment-grade companies.
So companies like BHP, Commonwealth Bank, Telstra, those kind of big names.
Exactly, the ones that are less likely to default on their debt.
Right.
So their bonds are considered pretty safe, and they usually offer better returns than government bonds.
Okay, so we've got our stability from those government bonds, potentially higher returns from the corporate bonds. What else should we be thinking about?
Well, remember, Gilt talked about liquidity. So we want to make sure that we've got some money that we can get to easily. So putting some of our portfolio into those short-term bonds or money market instruments, that's important.
Okay, so that's our emergency fund part of the portfolio, right?
You get it.
Makes sense. All right, and then to round things out, let's talk about those inflation-fighting bonds.
Right, yeah. With inflation potentially on the rise, it's definitely smart to include some inflation-linked bonds like those Treasury index bonds we mentioned in our portfolio.
So these bonds, they're kind of like our financial raincoat. If those prices start pouring down, we're protected.
That's a perfect way to put it. They're designed to help you keep up, even if prices start climbing.
Okay, so we've got our government bonds, we've got our corporate bonds, we've got our easy access money, and we've got our inflation protection. That sounds like a pretty well-rounded fixed income portfolio.
It is.
But how do we actually decide how much to put in each of those? Is there like a magic formula or something?
There's no one-size-fits-all answer, unfortunately.
Okay.
The best way to split things up depends on, how much risk you're comfortable with, what your goals are, how long you plan to invest. Someone who's closer to retirement, they might want a bigger chunk of their money in those stable government bonds.
Makes sense.
But someone younger, they might be okay with putting more into those corporate bonds where there's a chance for higher growth.
So it's really about, tailoring your portfolio to what works for you.
Exactly, exactly. It's all about finding the right balance for your individual situation.
Okay, well, I mean, honestly, with all this talk of trade wars and markets going up and down and economic uncertainty,
hmm
some people might just want to like bury their savings in the backyard and just wait for it all to blow over. What would you say to those people?
I get it. I totally understand that feeling. But the thing is, if you pull out of the market completely, you might miss out on any gains.
Right.
Even when things are volatile, there are still opportunities out there, especially if you have a good strategy and you stay informed.
That's where Gilt's advice really comes in handy.
It
So
does.
it gives you that framework to work with. Okay, let's get a little more specific. We talked about BHP, Commonwealth Bank, Telstra as examples of companies that issue those investment grade bonds. What are some other names that we should be watching out for?
Well, here in Australia, companies like Wesfarmers, Woolworths,
Mm-hmm.
Transurban, those are generally considered to have really strong credit ratings, really solid performers. And then if you're looking globally, companies like Microsoft, Johnson& Johnson, Nestle, those are good examples.
So those are the big established players, ones that have a good track record and
hmm
are less likely to just, disappear overnight?
Exactly, exactly. They've been around the block a few times.
Yeah, exactly. But how can the average investor know if a bond is actually, investment grade? Is there some kind of like secret handshake or something?
No secret handshake, but there are these credit rating agencies,
Hmm.
like Standard & Poor's, Moody's, Fitch.
No.
They basically evaluate companies and governments looking at their financial health, how likely they are to repay their debts.
So they're like financial report card graders.
Exactly. Yeah, they give ratings to those bonds, and the ones with the higher ratings, those are considered investment grade.
Okay.
So, for example, that usually means BBB or higher from Standard & Poor's or
Hmm.
Baa3 or higher from Moody's.
So the higher the rating, the lower the risk.
Basically, yeah. It gives you a sense of how safe that investment is considered to be.
All right, got it. But even with those top-rated bonds, there's still some risk, right?
Absolutely. I
Yeah.
mean, no investment is completely risk-free.
Right.
Even the most financially sound company, they could run into unexpected problems.
Right.
That's why diversification is so important.
Hmm.
It helps to spread that risk around.
So even if one of our, blue chip companies hits a rough patch,
Yeah,
the other investments in our portfolio can kind of help to balance things out.
exactly. It helps cushion the blow.
All right, makes sense.
Yeah.
Okay, so we've covered diversification, prioritizing those quality bonds, understanding those credit ratings. Now let's dig into this whole staying informed thing.
Okay.
It can be tough to keep up with all the financial news that's out there.
It can.
What are some of the key things that investors should really be focusing on?
Well, you're right. It can be overwhelming. But I'd say the most important thing is to really pay attention to what central banks are doing and saying the decisions made by, the U.S. Federal Reserve, the European Central Bank, the Bank of Japan, and of
Mm-hmm.
course our own RBA here in Australia.
Hmm.
Those decisions, they have a huge impact on interest rates, bond yields, how the markets are feeling overall.
So are you saying I need to like become an expert in central bank policy overnight? Because that sounds a little intimidating.
No, you don't have to be an expert, but just understanding the basics of what they do and why they do it,
Mm-hmm.
that can be really valuable.
Okay, central banks, check. What else should we be paying attention to?
Well, keep an eye on those key economic indicators, things like inflation, GDP growth, unemployment rates, consumer confidence.
Oh, yeah.
All of that gives you a sense of how the economy is doing overall,
Right.
which can then affect bond yield and how volatile the market's going to be.
So a little bit of economics 101 is helpful too.
Got it.
Anything else we should be adding to our information toolkit here?
Yeah, don't forget about what's happening in the world, those geopolitical events, things like uh, trade wars, elections, any kind of political instability, even natural disasters.
Mhm.
All of that can have a ripple effect on the financial markets.
So basically, we need to keep an eye on the whole world.
In a way, yeah.
This is starting to feel like a lot.
I know it's a lot to take in, but you don't have to be an expert in everything. Just focus on the information that's most relevant to your own investments and find some reliable sources you can trust.
That's good advice. All right, well, we've covered a lot in this first part of our deep dive today. We've talked about building a diversified fixed income portfolio,
Mhm.
Why those credit ratings are so important and how to stay informed in a world that just seems to get crazier by the day.
Yeah, it's a lot to process, but it's really important stuff, especially for anyone who's trying to, navigate this fixed income market.
Absolutely. So we're going to take a quick break, and we'll be right back to explore some additional strategies and leave you with some things to think about. Stay with us.
All right, so, now that we've kind of set the stage, I want to talk about a strategy that, maybe can help you boost those returns a bit in a market like this, a market where things are kind of all over the place. And that strategy is called active bond management.
Active bond management. Okay.
Yeah.
I've heard that term before, but I got to be honest, I'm not really sure what it actually means.
Yeah, yeah, it sounds a little, jargony.
A little bit.
But
A bit.
but basically it's like having this, expert, this seasoned pro who's managing your portfolio for you. Instead of you just kind of setting it and forgetting it, they're constantly watching the market, making adjustments, trying to take advantage of opportunities, minimize those risks.
So instead of me sitting here trying to figure out like when to buy and sell,
Yeah.
I'd have someone doing that for me who really understands, the bond market and how it all works.
Exactly. Exactly. Active bond managers, they have that expertise. They can spot those undervalued bonds. They can kind of anticipate those interest rate moves, which are always tricky. And they can adjust, how long your money's tied up for, that duration we talked about, and the credit quality of your portfolio, all to, potentially get you better returns.
That does sound pretty sophisticated.
It can be.
I mean, I imagine there are fees involved with having someone, manage my investments, though, right?
Yeah, you're right. There are costs associated with active management, but, the potential to actually do better than the market, especially when things are, as crazy as they are now, that can often make those fees worth it. The key is to find a good manager, someone with a solid track record.
So it's like having like a skilled captain steering your ship through those stormy seas.
Exactly.
It might cost you a bit more, but their experience, could really make all the difference. Okay, so let's zoom out for a second.
Okay.
With all this talk of trade wars and markets going up and down and economic uncertainty, it's easy to get caught up in the fear of it all.
It is. It is. I understand that feeling. But, you got to remember market cycles, these ups and downs, they're just a natural part of investing. There are always going to be good times and bad times, periods of growth and periods of, contraction.
So instead of panicking and making, rash decisions, we should just kind of focus on that long-term strategy.
Exactly. Keep your eyes on the prize, those long-term investment goals. Stick to your diversified portfolio and don't let those, short-term market hiccups throw you off track.
That's good advice.
Yeah.
So if you had to like sum all of this up, all this information we've talked about today into like a few key takeaways, what would they be?
All right. Well, I think the first one is probably the most important. Investing in fixed income, it's not passive. It takes, you got to be engaged, you got to keep learning, and you got to be willing to adapt as the market changes.
So no burying our money in the backyard.
Definitely not. No. Yeah. Definitely not. The second takeaway, I'd say, is diversification. We talked about that. Spreading that risk, different asset classes, bond types, maturities. Don't put all your eggs in one basket.
Got it. Diversification is key. What else?
Prioritize quality. Look for those bonds issued by organizations with good credit ratings.
Great.
They might not have the highest yields, but they offer something that's just as important, and that's peace of mind.
Quality over those risky bets, especially right now. Okay, what else should we be thinking about?
Liquidity, we talked about that. Make sure you've got some of your money and things you can access easily, just in case, you need to adjust quickly, or maybe a great opportunity comes up.
So it's like having that rainy day fund, but for our investments.
Yeah, exactly.
Makes sense. Anything else we should have on our radar?
Don't forget about inflation.
Right.
It can really sneak up on you and erode that purchasing power. So, consider putting some of those inflation-linked bonds in your portfolio.
Yeah, right. Those inflation-busting bonds, like our secret weapon.
Exactly. And finally, never stop learning. The more you understand about how the global economy works, how the financial markets work, what affects those bond yields, the better decisions you're going to be able to make.
So knowledge is power when it comes to fixed income.
All right. Well, we've covered a lot of ground today, from the impact of those trade wars to, how to diversify those bonds, even to active management.
It's been a lot, that's for sure.
It has been a whirlwind tour of the fixed income world. But hopefully, we've given our listeners some tools and some knowledge to help them navigate it all.
I hope so.
All right, and on that note, we're going to wrap up this part of our deep dive into the world of fixed income. But before we go, I want to leave you with one final thought.
Okay, I'm listening. With everything we've talked about today, I want you to think about what you're doing to make sure that your investments, they can handle whatever comes their way.
Hmm.
Are you diversified? Are you prioritizing quality? Are you staying informed? The answers to those questions, those are going to determine how healthy your portfolio is in the long run, how well it can handle those ups and downs.
That's a great point. Investing, it's a journey. It's not just a destination.
Very well said. All right, well, thanks for joining us on this deep dive into fixed income. We'll see you next time for another exploration of, well, who knows, some other fascinating topic. Welcome back to the deep dive. We've been talking about how to navigate the fixed income market. Making sure your investments are as safe as they can be in these kind of uncertain times. And we've talked about diversifying, prioritizing quality, staying informed, all that good stuff. But Gilt Investments, they had one more one more interesting point in their playbook that I wanted to touch on before we wrap things up. And they talked about this thing called duration and how it plays a role in managing risk, especially when interest rates are all over the place.
Right.
So what is duration exactly, and why should we care about it?
Yeah, it's a good question. And duration, it can seem like a kind of technical thing, but it's pretty important for anyone who's investing in fixed income. So think of it this way: duration. It's basically a way to measure how sensitive a bond is to changes in interest rates.
Okay, so the higher the duration,
Yeah.
the more a bond's price is gonna fluctuate when interest rates change.
Exactly, yeah. So a bond that has a longer duration, that means its price is going to swing up or down more dramatically when those interest rates change
Yeah.
compared to a bond with a shorter duration.
So if I'm worried about interest rates going up, should I be sticking to bonds with those shorter durations?
That's definitely one strategy to consider. Yeah, those shorter duration bonds, they offer a bit more protection if those rates start climbing. But, the trade-off is that they might also have, they might not have as high of a yield.
Okay.
It's always a balancing act,
Right.
between potential return and how much risk you're willing to take on.
Right. No free lunch, as they say. All right. So we've talked about managing risk through, diversifying, choosing those good quality bonds, understanding duration. Are there any other strategies that investors can use to kind of protect themselves, in this kind of unpredictable market?
Yeah, absolutely. One other strategy that can be really helpful is something called laddering your bond maturities.
Laddering.
Yeah.
Yeah.
So basically what that means is you spread out your investments across bonds that have different maturity dates.
Okay, so I'm picturing a ladder in my head now, and each rung is a different maturity date.
Yeah, exactly.
But how does that actually help with managing that risk?
So let's say, you're thinking, okay, I want to invest for 5 years.
Yeah. Okay.
You could build this bond ladder, right? You could have
Oh.
bonds that mature in 1 year, 2 years, 3 years, 4 years, 5 years.
Mm-hmm.
And as each bond matures, you just take that money and reinvest it in a new bond, one that matures further down the line, and that keeps your ladder going.
Right.
And what that does is it helps to kind of smooth out the impact of those interest rate changes,
Mhm.
and it also gives you the opportunity to potentially get those higher yields if rates do start to rise.
So it's like this rolling wave of maturities,
Yeah, that's a good way to put it.
constantly adjusting, as those interest rates change. That's pretty clever.
Yeah, it's a smart strategy. And, the more you learn about these different strategies, the more tools you have in your toolkit.
Excellent.
And the better you can, kind of weather those storms that come along.
For sure. I'm starting to see how all these pieces, fit together. You diversify, you choose those high quality bonds, you understand this whole duration thing, you ladder your maturities, and suddenly you have this portfolio that's a lot more resilient.
It is, yeah. It's about building that strong foundation, so
Yeah.
you're not so easily shaken when things get rough.
Exactly. Any other words of wisdom you want to share before we wrap things up?
Oh gosh, we've covered so much today. I think if I had to leave our listeners with one final thought, it would be this: don't be afraid to ask questions.
Right.
Investing, especially in fixed income, It can feel really complicated, and there's a lot of jargon,
Mm-hmm.
but it doesn't have to be a mystery.
Mm-hmm.
There's so many resources out there. You can talk to a financial advisor. There's tons of stuff online, educational materials. You can learn about this stuff.
Right.
And the more you understand, the better decisions you're going to make,
Mm-hmm.
decisions that are right for you and your financial goals.
Yeah, that's great advice. Don't be intimidated by all the, the fancy terms or how complicated it might seem at first. There's help out there, and the more you learn, the more confident you're going to feel about it all.
Exactly. Exactly. Knowledge is power, right?
Absolutely. All right. Well, on that note, we're gonna bring this deep dive to a close. But remember, in a world where everything's changing all the time and there's so much uncertainty, knowledge really is power. So
Yes.
keep learning, keep asking those questions, and keep building that portfolio that can weather any storm. Thanks for joining us, and we'll see you next time for another deep dive into, well, you never know what we'll explore next time.